into the United States. I am thrilled to be joined by tax attorney and US and UK and Australian tax specialist, Bradley Murphy. Thanks so much for joining us, Brad.
Thanks, Ashley. Thanks for the kind intro. It's very, very nice.
Just a few disclosures before we get into that. Please note that today's presentation does not constitute personal financial, tax, or investment advice. That is what Brad and I are in the business of doing, is providing personal financial, tax, and possibly investment advice, depending on who it is you're talking to here. So this is really for general information to maybe let you know a little bit about what it is that needs to be considered in taking such a move. Do be aware that this presentation is being recorded and is going to be posted along with all of our presentations on our YouTube channel. I'm pleased to say that the May webinar with Donald Griffin on estate planning considerations for the American and Australia is up. I also wanted to thank Brad and thank everyone else for their patience here. Last month, I came down with some sort of gastrointestinal bug just before the presentation was due to go live. I ended up losing 7 pounds over 3 days. So not good, but feeling much better now. And I just thought I would take a moment, introduce myself, and then perhaps Brad could say a few words about his background as well. So I came to be a cross-border financial planner because that was my situation. I am a tri-citizen of the US, the UK, and Australia. And in moving to the United States in 2005, starting in corporate finance as I did, I began to wonder about what sort of resources existed or what groups existed out there that actually would educate me on the things that I needed to know as an individual with cross-border financial complications going on. It wasn't until 2008 I made a transition to become a financial planner, and then I spent the next couple of years networking, learning everything I possibly could about international and cross-border matters. And since then, I have launched Arete Wealth Strategies a decade ago. Actually, our anniversary is coming up in about 3 weeks, so that will be wonderful. But also, I launched the Global Financial Planning Institute to educate financial advisors on the issues they need to be aware of in working with this particular group, because there are so many things that are different, as Brad would surely testify, in this cross-border context compared with the domestic context. And if you're talking to any financial planner who is not a GFP, then they are trained on a domestic environment. And so that's very important to know. Let me hand it over to Brad for a bit of an introduction from him.
Thanks, Ashley. Thanks for the kind words as well. And glad to hear you're feeling better. But yeah, look, like Ashley, I also experienced life as an expat and work with some of the big firms in the international tax space with Deloitte, EY, and Qantas, and got a real feel for the international tax space and saw a bit of a, I guess, niche in the market there, working in the UK and US with expats not getting real sort of personalized cross-border advice, and saw it was a real niche area where business owners and individuals needed that interaction between the two countries. So decided to start my own firm about 5 years ago now, called Murphy Tax Lawyers and Advisors. We're based out of Australia with offices in Sydney and Melbourne. I'm an Australian tax lawyer myself and tax agent. But as Ashley mentioned, we have a strong focus on the US and Australian channel. It's probably our biggest market. I'm obviously Australian qualified, but do a lot of work with US expats and work with US attorneys on matters frequently.
Thanks for that, Brad. It's probably worthwhile mentioning just 2 points, and that is we both have the same last name, but we are not related to each other. And then the second thing is how we work together. Brad, I've been impressed with your experience, your approach to the business, and when we have a client situation that warrants your expertise, that's when we'll make an outreach. And perhaps you could mention, what the financial advisors you deal with and so forth.
Yeah, that's a great point. And of course, tax and financial advice go hand in hand. they're very much integrated. And I think why I really enjoy working with Ashley is because he does have that cross-border financial experience, and especially as a US expat, it's really important to get it right. So the tax advice and financial advice, if you're looking at Australian super planning, US retirement fund planning, or if you sold a business, how to invest that and to escape some of the nasty PFIC rules in America, for example. It's really important to get the tax advice going hand in hand with the financial side. So I do enjoy Ashley's expertise on that front too. And I would say too, it's a really niche area. I mean, there's not many people doing it well, I think, as well. So I think, there's not that many Australian US tax accountants or financial advisors in this space.
Yeah, that's right. It's also worth mentioning we don't pass any referral fees. Brad and I work with each other based on our expertise. That's it. There's no shared compensation of any kind. Some examples of the kinds of clients and issues that we assist with, just 3 that I'll briefly point out before getting on with today's presentation. One would be the Australian business owner living in the US. Another would be the high net worth family currently living in the US, but really trying to set up a globally mobile life. And the third would be the Aussie executive family that have permanently relocated to the US. And here is just some listed the goals that the clients had and the results that we've been able to attain for them. So with that said, let me introduce you to today's presentation. Really the first half, or maybe even more like first 2/3 of today's presentation, will be run by Brad. He'll be going through. Actually, Brad, do you want to just talk about the issues you'll be addressing, and I'll address the last 4 here.
Yeah, sure. So I'll look at tax planning across the US and Australia and how that can make a big difference to your overall net worth and after-tax cash. Looking at tax residency in Australia and the US. We'll look at some of the considerations for expanding and growing your business from Australia to the US, and how to repatriate those funds back to Australia, depending on where you're residing. And then some of the other issues in terms of how to fund the US business and some of the US compliance issues as well. Oh, sorry, Ashley's going to actually take that one. Sorry to steal your thunder. No worries.
It did, but Brad, we had a Brad/Ashley on that one, and I thought, you know what, I'll just take that one. So I'll briefly be covering US tax compliance and also investment considerations to do with PFIX that Brad mentioned a little while ago. US tax basis, Brad may have a thought or two to add on that, but that's to do with what the tax basis is of assets that you bring to the US. How does that work, and how does it contrast with how Australia works? And then I'll talk briefly about retirement plans, US retirement plans, and how they're especially beneficial for individuals that are not US citizens or permanent residents, how that could form part of your US business establishment plan and wealth plan. And then finally, something else to be mindful of, and that is the exit tax, otherwise known as the Hart Act. I'll be just running you through a brief diagram on that. But I think this is an excellent outline of what someone needs to be aware of. If they were a business owner looking to expand to the US, they would do extremely well to talk to Brad or myself and just get this brief. In fact, I've got a call coming up later today with someone who's in precisely that situation. And it's very helpful that we've got this concise list of things to be aware of, because it does differ if it was just an individual moving over as an employee. But with that, let me hand it over to Brad. And Brad, I'll just do the slide transitions for you. So if you want to let me know when you'd like to change slides.
Yeah, great. Thanks, Ashley. Yeah, so we'll start on the tax planning piece. And look, it probably goes without saying that it's obviously important to get advice before the move to America, just given the inherent nature of the Australian and US systems. They're particularly complex. I mean, look, at a high level, there's obviously a tax treaty between the 2 countries to alleviate double tax in most scenarios, but it's certainly a lot more complex than that. And particularly if you're looking at issues in terms of selling property or selling a business and super and retirement planning, the treaty does not really allow for those sort of discrete issues properly. So I think it's really important to look at what is your time frame for living in the US. Are you going there on an E3 visa for a couple of years versus a more permanent move towards a green card and citizenship? And certainly if you do move towards that, green card citizenship approach, then that's going to basically tie you into the American tax system for life. And Ashley will probably allude to later to give up that long-term green card or US citizenship. There is an exit tax for the privilege of doing so. And particularly if you're coming back to Australia with a green card or US citizenship, that can be particularly tricky in that, you still need to report and file in the US for life. And there are some mismatches there between the two systems, which can make it problematic. But perhaps we'll start with some of the perhaps negative news first before we get into some of the more tax planning strategies we can implement. But some of the common issues I see in practice, and so with Ashley, would be moving to the US and you've got an Australian property that's been your main home, and you look to sell that from the United States. That's going to be fully taxable in Australia and the US. So Australia would say that the main residence exemption is denied if you sell that property as a non-resident of Australia. And it's also potentially taxable in the US under their main residence exemption as well. And perhaps we'll come back to that in a moment. But yeah, if you are looking to leave Australia, it's really important to look at, can that property be sold before you go? You have the option to rent it out for 6 years and come back to Australia, but it does involve some thought and planning. Perhaps the biggest issue we see in practice on the individual side is certainly Australian super and 401k planning, IRA planning in America. At a high level, the US IRS does not like Australian super funds. In a nutshell, making voluntary contributions to those super funds will mean normally they're fully taxable in the US and also reportable. So the compliance fees to report the Australian super fund can be quite high on an annual basis. And I guess more importantly, the growth and income of the super fund is taxable each year in the US with no credit for the Australian tax paid. Especially if you've got a self-managed. Sorry, Ashley.
Brad, can I ask a question there? And I think our viewers will find it extra valuable if we have some interaction and ask some questions.
Yep.
So to do with superannuation, do you always take the position that it's taxable on an annual basis, or might there be a situation where someone's contributed less than 50%, they're not doing anything with regards to the super account, where it might take a different kind of tax treatment?
Yeah, look, that's a good question. And it certainly does depend on the nature of the super fund back in Australia and how much has been made in terms of contributions. Like certainly a self-managed super fund in Australia will be treated as a grantor trust in the US. And that's really, quite problematic in the, the annual growth of that self-managed fund will be taxable in the US. And that can be an issue, especially if that self-managed fund holds, say, commercial property or residential property in Australia, which is pretty common. That's definitely problematic. But to your point, in contrast to, say, a normal retail super fund, where normally is being funded by way of employer contributions in Australia, where the employer's, putting in the mandatory 10 to 11%, that's normally okay on the American side. Effectively, it's treated as an employee benefits trust as opposed to the grantor trust approach. But where it can be an issue is if you're putting in more than 50% of the contributions yourself personally. And that's when that treatment can switch around from an employer funded scheme to a personal scheme, which is normally an issue. And look, there are things you can do as well, like you can claim a tax credit in the US for the Australian tax paid that gives you a basis in the US to sort of mitigate some of the damage over there. And of course, it does depend on your time frame, right, of living in the US. If it's a couple of years and you've got a retail fund back in Australia, it's probably not so much of an issue versus a long-term move where you go towards a green card and you've got a grantor trust back in Australia through a self-managed fund.
Okay,
thank
you.
Yep. The other one, the PFIC rules, as you mentioned before, Ashley, and no doubt you'll speak about this more. And maybe it's a good time for you to jump in after my thoughts too on your thoughts on how these would apply to US citizens. But effectively, the US says that if you hold Australian or any foreign mutual funds or any foreign ETFs, they're caught up in what we call the PFIC rules, the passive foreign investment company rules in the US. And the issue with that is obviously it's quite common for Aussies to move to America and hold a portfolio of Australian mutual funds, Australian ETFs. And how the US would tax those would be the year-on-year unrealized gain is taxable in the US. So you might have actually sold an ETF or sold a mutual fund, but the annual growth of that ETF is taxable in the US at quite high tax rates as well. But probably more prominent is the annual reporting on these PFICs. There's basically a separate form for every single PFIC. So, if you got 10, 20 ETFs back in Australia, you're going to need 10 or 20 forms to report, and the compliance costs can add up, pretty quickly.
It seems like to me, like all but high net worth individuals, the actual tax compliance can be worse than the tax itself, and the tax itself is pretty nasty.
Absolutely, that's so true, and that's what we often see with clients, where the annual compliance cost is more than the dividends or income coming out of these things. So, and it's crazy. You can buy the exact same PFIC normally, or in terms of ETF on the American market, which normally can get outside these rules, and I'll let Ashley maybe expand on that a bit later. The other issue we see is in terms of employment arrangements. It's normally certainly preferred from a tax compliance point of view if you can work on US payroll as opposed to Australian payroll over in the US. Obviously, it's quite common at the moment where people are working remotely in the post-COVID era. Because effectively, if you have moved to America and you're doing your work from the US, even if you're employed or working for an Australian company, the US is going to tax that income, and only the US, not Australia. Where we see a common issue in practice is getting that pay-as-you-go withholding back from the ATO for the taxes paid by the Australian employer. Normally, it's going to mean approaching the ATO for formal release or refund of that tax, and that involves a full written objection to explain why you're not resident of Australia, and it does get quite time consuming and costly. So the options are normally would be to revert to an independent contractor, or if the company has got a US entity, to be employed directly out of America. The other issue we see is that US state taxes, which often get overlooked, especially California, New York, with the high state taxes. And the issue there is obviously, it's not great they impose tax, but also the states don't offer a tax credit for the Australian taxes paid. So at the federal level, the US does give full relief for any Australian taxes paid, but the states do not. So a common example would be you have Australian rental income, you have an Australian business earning dividends, for example, you would get a tax credit at the federal level, but not at the state level. So the effective tax rate can jump up quite quickly on that. And I think the other huge issue is if you decide to live in the US long term and go for that green card and US citizenship, that will mean that you are effectively tied into the American tax net as long as you have that green card or citizenship, and that will involve obviously ongoing reporting and filing of tax returns in the US. So bear that in mind, and to give up the green card if you're a long-term green card holder, so you've held the green card for more than 8 years and your net worth is over $2 million US, there is an exit tax to give it up. Same with US citizenship. If you were to relinquish the US citizenship, there's also similar exit tax. I think the biggest thing we see on that in practice would be, US citizen with a partner with a green card comes to Australia, they want to put money into Australian super, start a trust in Australia, start a company in Australia. It just makes all that very difficult. And that's why, we normally recommend having assets and companies and trusts in the non-US person's name where we can. Yeah. And sorry if that was, all quite negative. Hopefully there's a bit more positive stuff to come. I mean, on a positive note, I would say the sort of like generic, more mainstream E3 2-year short-term move to the US would normally mean that the US federal rates of income tax are lower than Australia. So if you're looking at purely from an employment perspective, normally you'd be a bit better off from an employment income tax perspective by living in the US than Australia. So it's probably one positive to the move. So yeah, looking at tax residency, this is important, particularly from the Australian side, because it does drive a lot of tax outcomes, particularly in Australia. The US is very clear. It's obviously a day count test. If you don't have a green card or citizenship, if you do have a green card or you're a citizen, then you're automatically US resident. But normally just back on that day count test. So if you've got an E3 visa or another visa and you're spending time in the US, that is a test to consider, how many days you spend in the US. And if you're spending more than half the year in America, then basically automatically going to be a US tax resident. So normally pretty clear, if you move into the US, you'll be a resident on the day of your arrival over there. Whereas Australia's got a more subjective test. To break Australian residency, it can be difficult if you're going for less than 2 years on a temporary type basis. So something to bear in mind would be that if you do or are looking to move to America on a short-term basis for under 2 years, you would normally remain Australian tax resident, and that's where we look at the tax treaty to determine who would tax what income. But if you're going for more than 2 years on an E3 visa, normally you'd be non-resident of Australia if you had the intention to be there for 2 years or more. Okay. Yeah, I think, I guess the other point with that would be under the treaty, if you're working from the US and you've got accommodation in the US under the treaty, your employment income should only be taxable in the US and not Australia, even if you were to remain Australian tax resident.
I think that's a good question right there, Brad. So I was contacted by someone, this is just a random scenario, but maybe helpful to others listening. So I was contacted by someone, a friend of a client, just having a brief call to help him out. His wife is a physician, being relocated to Boston for 6 months on an E3, I believe. So his tax residency, are you saying he would actually remain an Australian tax resident for that entire 6-month period despite living and working in the US?
Yeah, that's exactly right. Yep, exactly right. Yep. Wow. So good example there. Yeah, actually we see a lot in practice, sort of a short-term move to the US for 6 months or a year, for example. In that case, the client would certainly remain Australian tax resident. And that the starting point from that would be that all the income is taxable in Australia. And that's the way the ATO would see it. And then you need to look at the tax treaty to see, who taxes what income. And look, you're always going to get tax relief. There's never going to be double tax, but there can be potentially top-up tax situations. I think the other point would be that where residency is important is you're looking at things, particularly, as I mentioned before, your Australian property. If you're a non-resident of Australia and you sell that, you're going to get hit with full tax, whereas if you're a resident, you won't. But in contrast, if you're an Australian tax resident and you've got other income coming in, that's going to be still taxable in Australia. Yeah.
Good point.
And it's hard. It's never really a one-size-fits-all answer. It would very much depend on your asset base, your intentions, how long you want to go for, as to if it's better or worse to cease residency of Australia.
Did you have a point or two more to make on this slide, or do you want me to go to the next slide?
Yeah, I think we can probably move on. Yeah. So if we look at moving your business to the US, and again, there's never a one-size-fits-all approach. Particularly with America, that's got several different options to run your business through. And at a high level, you've got normally 2 or 3 different options. You've got the LLC or S Corp, which are normally disregarded entities in the US, which means that the member or the shareholders pay tax on that income from those entities as opposed to the corporation itself. So in Australia, everyone's normally used to an Australian company, which would pay tax in its own right at 25%. Whereas in the US, you've got these two options, LLC or S Corp, which can be a single member or a partnership vehicle. And it means that the profits of those vehicles flow through to the owners, and the owners pay tax personally. And at a high level, right? Normally, it's certainly advantageous if you're living in the US and you're running a self-employment business to operate through normally the S Corp or the LLC. It does offer some advantages through self-employment deductions that the corporation does not. But in contrast, because the corporation pays tax in its own right, if you're operating a significant trading business that you're looking to sell, it's normally preferred to utilize the 19% company tax rate in the US and retain profits and after-tax profits in the company. And particularly, you can often access small business concessions as well when you sell that corporation. And certainly, if you look into issue stock to members or issue employee share plans, normally corporations going to be the way to go.
Brad, I'm so excited by that one that you just mentioned that I want to double down on that one, the qualified small business stock exemption.
Yeah.
So there's a few rules to it. It can't be in certain areas. Financial services is one that I happen to know is not included. But if you're in some sort of manufacturing business, or if you're making some kind of even an information product, like a software company, for instance, then you can qualify for that. And provided you pass certain rules, the C Corp, it's below a certain, the exit ends up being, I think it's below 50 million.
50 million.
And there's at least a 5-year holding period, then that could be exempt from federal capital and possibly state. I think it depends on the state, but definitely federal capital gains. So for the audience that we're addressing today, if you can structure your business to do that, wow.
Yeah, absolutely. And then, actually, as you know as well, you've got the option to put some of those proceeds into potentially retirement vehicles or other trusts to lower that tax burden even further, from both a tax and estate planning perspective. And I mean, this presentation won't go into estate planning too much for now, but I think everyone knows Australia does not have estate tax, which is great, but the US does for high net worth individuals. So something to look at too. So I guess, those considerations, they're really good from a US specific point of view. If you are residing in the US, where it does become a lot more problematic would be if you have a US business and you come back to Australia to reside, because that's where, when you do come back to Australia, or even if you start out having an Australian company that expands to the US, normally Australia is going to tax a piece of that US company on the income of that, and plus when you exit from a capital gains perspective. And this is where the planning needs to be done carefully to look at what is the best way to, A, get the money back to Australia in the most efficient manner, and B, on exit, how do you actually sell that company in the most effective manner? I mean, at a high level, where it's really not great is if you've got a US LLC or even corporation, you're living back in Australia and you're extracting dividends or income salary from that. Normally, it can be taxed pretty highly back in Australia. So that's normally where you'd be better off if you can be structured appropriately to have an Australian company that to the extent it can get management fees or income from the US back into the Australian company and taxable at a 25% tax rate in Australia, and utilize that to distribute income to the shareholders and family back in Australia more effectively.
That's a really great point. Good one, Brad. Yeah, I like that.
Yeah, but and it's never, as I said, a one size fits all. It's going to depend on a few factors for sure, but that's certainly something to think about. And the other common example, which actually me and Ashley have been working on for a client recently, which has been certainly interesting, is where they had an Australian basically family trust that's owned a US business, and they've gone and sold this business while they're US tax residents, and they thought the whole time that it's going to walk away and pay US capital gains tax on this exit. But unfortunately, because it's an Australian trust that holds the business, the ATO said, look, we want our fair share of that tax as well. And I guess the issue with that is, yes, there is tax relief to offset double tax, but in this case, the Australian tax was about 20% higher than the US tax. So, you know, that's why it's just important to think about how this should be structured from the outset. And normally, yeah, you know, it's quite common in Australia to have an Australian trust owning your company or your business, which is great on the Australian side for sure. But just be aware that, you know, if you are looking to leave Australia and you've got this trust in place, it's not always the best outcome and needs to be, you know, thought through quite carefully.
I just wanted to, sorry to interrupt, Brad. I just wanted to mention something quickly to do with what folks may not be aware of. Given the difference in tax rates here, you can see this. I've got my key financial data sheet right here. But here's the thing: is most Aussies don't know that there's really only two tax schedules that apply, and there's the residence rate. And of course, there's the progressive scale that applies there, but there's also the non-residence rate, and that starts at 32.5%. So really on the first $180,000 of income, you're looking at paying a significantly higher rate of tax. At 180, they equal each other. But I just wanted to point that out. So the shocking thing that could happen is, just going back to those slides now, the shocking thing that could happen in the kind of exit that you were just talking about, Brad, is one where you're paying the non-resident rate through the Australian Family Trust, and owning your shares through the Australian Family Trust was great advice. It was the right thing to do when you're in Australia. But then to sell as a non-resident, oh my God, this is financial harakiri. This is almost as bad as it gets, because now the gain is sourced back to Australia at non-resident rates with no CGT exemption. So you're paying non-resident rates on 100% of the gain. And the client Brad was alluding to, he's just had an exit earlier this year for about $50 million. That tax impact we're talking about is in the millions of dollars, or maybe low tens of millions of dollars of difference. That's how significant that is. Sorry, Brad, I just wanted to bang on the table a little bit.
Yeah, that's really, thanks, Ashley, for really sort of pointing out the tax rate differential there, because it is actually significant. You're right. It was, literally 47% tax. You don't get that exemption in Australia versus, 23, let's call it, if they did in the US and Australia. So it's a 25% difference in tax. Yeah. Yeah. Because then the other point too is that, without getting too technical here, when you do come back to Australia, any investments you own in your personal name get rebased to fair market value when you come back to Australia. So, it's normally common practice in terms of recommendations for our clients, in that if they're coming back to Australia, shares, private investments get rebased to market value for Australian purposes. And that means you're just paying Australian tax on the increase in value of those investments after you've come back to Australia. And if you're not US tax resident, there's no American capital gains tax on that. So you can get to a situation where you can sort of quarantine, in a way, almost all that growth if, the cards fall your way with some good tax planning as well.
That's a great point.
Yeah, it doesn't apply for if you've got a green card or you're a US citizen, because you're still paying US tax. But if you're on E3, for example, certainly something to look at carefully. And then when you come back to Australia, that's when you move the cash into the trust, and that it does offer tax planning once you're back in Australia. Yeah. So I'll move through. I know I'm probably taking out a bit of your time here, Ashley. But in terms of getting the profits back to Australia, I think we sort of touched on this, that individual tax residency is really key here for looking at your post-tax returns. Having companies in the two countries is great, but the really important thing is to think about how to effectively get that post-tax profit into your hands as the owners and shareholders, not so much at the company level. So bear that in mind. If you're a US resident, also be mindful of the fact that US has these, what we can call controlled foreign company rules, CFC rules, and they're quite important. I would say that, if you've got a US citizenship or a US green card and you're a controller of an Australian company, so you set up your own Australian Pty Limited, that's effectively what we call a CFC in the US, and that's going to be probably problematic in terms of reporting that in the US, and does limit the tax planning that could be done. So we normally recommend ideally having that Australian company in the non-US person's name if possible, or having it owned by a trust potentially, which the US person does not control or is not the trustee. But that's a specialized area. Just make sure you get some advice on that one. If you're looking to fund your US business, just think about how to best do it. And if you're looking at staffing of that, really important for the company to look at, are those staff residents of Australia or not? That does dictate the ATO reporting and super obligations for the company itself. Normally it's best, as I mentioned before, if they're not Australian residents, and that takes them outside the ATO reporting net.
But Brad, can we just have a brief conversation about that point? I spoke with an individual last week, a prospective client who is moving back from the US to Australia, and he was very happy that his company would let him do that and keep him on US payroll. I've seen enough of this, and I think you've seen much more of this given your tax expertise. But what I said to him was, I don't think this is going to last. I think companies realize how painful and non-compliant they are when they try and treat you as a domestic employee when you're in an international context. I actually think it's just a matter of time before HR and payroll catch on to the problems that they've created. And then what's going to happen is they're going to look at you and say, you're the only employee we have in Australia. Unless you're the CEO or someone super duper high up, it's not going to be worth it for us to be compliant with you overseas. So you're either going to be an individual contractor or you're going to have to get a different job.
Yeah.
Tell me, is that what you've seen? Companies are becoming less and less, post-COVID, they've done it enough where they realize, actually, this is not as simple as we thought it might be.
Absolutely. That's a really good point, actually. We're seeing that a lot at the moment. Like during COVID, even post-COVID for a while, it was really common for companies just to let employees work remotely, especially US employees, especially, let's just say, tech employees. This is probably the biggest one, having their staff work in Australia. Some didn't even know they were back here, I think. And some just said, look, we just want to obviously make sure everyone's happy for the time being, so we'll let them work remotely. That's certainly changed, I think, over the last 3 or 4 months, through obviously the mandate for staff to be back in the office, but more so, HR teams getting advice from their tax advisor saying, look, this is going to create issues for the company, having staff working, in Australia or the US, as it may be. Because strictly speaking, the company itself, right, if you've got an Aussie employee working for a US company, the company should be actually, paying pay-as-you-go installments to the ATO on the employee's behalf and paying the employee's super. And also for the employee themselves too, it's quite messy, because normally in that situation, because they're working in Australia, they'll owe tax to the ATO first on their income, and they must self-declare that and pay tax on that money to the ATO. But they've had withholding applied by the US company on a W-2. And then it's a case of, okay, how do you get the W-2 withholding back from the US company to fund your Australian tax bill? And I think historically what most accountants in Australia have probably done, not all, I'm sure, would have claimed a tax credit in Australia for the US withholding taxes applied. But I think it might be a matter of time before there could be some more attention on that from the tax office.
Okay, thanks for that.
Yeah. But yeah, just to answer, that's a really, really common issue we're seeing, and perhaps, the biggest issue we see on the employee side, for sure.
Okay, so the loan versus equity, yeah.
Yeah, look, I think we can probably just run through this relatively quickly, just in terms of how to fund that US company from Australia. If you've got an Australian company, and the choices would be a loan versus equity. Normally, it's better to loan the money across, just given that debt and interest is deductible debt, so you can claim a tax deduction for it. But I think just at a high level too, just make sure you're considering transfer pricing between the Australian company and US company, just to make sure it's all been done at commercial rates as well. Yeah, and it may not be so much of an issue if you're a smaller startup, but certainly once you're over $2 million of sales between the two companies or transactions, then certainly make sure you're complying with transfer pricing requirements in both countries. Yeah.
All right. So this is where I move in and talk a bit about tax compliance. So really there's three areas that I want to talk about, and that's to do with income tax filing. The second is to do with informational reporting, and the third is, as Brad was talking about earlier, is to do with investment restrictions. But let me just go through this first of all, and that is who is required to file a US tax return? And the answer to that is really anyone that's considered a US tax resident who has income above the levels that we see here in this table on the right-hand side. It's as simple as that. The US, what's noteworthy about the US tax system is you are required to file, assuming you have income over these levels that we see here, no matter where you are in the world. If you're in Antarctica, Zimbabwe, anywhere in between, and you have the income above these levels as these kinds of filing statuses, then you're going to need to file. The next thing that we'll talk about is to do with informational reporting. The thing with informational reporting is there's no tax necessarily that goes with it. This is just the US wanting to know what's going on overseas. It originally, the FBAR form came about through the Bank Secrecy Act in 1970, wasn't really particularly well enforced. It was one of those rules on the book that people like Brad would know about, but was never really practiced until about the last dozen years. And that was when FATCA came into effect in 2010, and I'll talk about that in just a moment. But when FATCA came into effect, suddenly in the age of information sharing, in the age of the internet and so forth, it became a lot more feasible for US regulators to actually enforce these rules, some of which had been on the books for decades, some of which were in fact new. But the situation with the FBAR, it's really very simple. If at any point throughout the year, the calendar year, because that's the US financial year, of course, if you have an aggregate bank account balance of greater than $10,000, then you must file an FBAR. FBARs, thankfully, are relatively painless, unlike PFIC forms. You just enter the information of the bank account, the bank balance. That's it. People get fearful, heart palpitations and so forth, thinking, oh my God, they're going to come after me and tax me for it. No, they actually just want to know about it. That's really it. But here's the thing, the reason why this one always seems to come up in presentations like this is because the penalties for failing to file are substantial, starting at $10,000 per form. It was recently confirmed, not per account, it's actually per form. But either way, I wouldn't want to see any client of mine get a $10,000 fine for failing to file one of these forms. But just a point to clarify there, Brad, I've got aggregate bank accounts. Are you familiar with whether that would include investment accounts or super balances?
Yeah, it's good question, Ashley. Potentially yes to the super as well. And if it doesn't go on the FBAR, your Australian super would go on a separate US form for sure. But yeah. Okay.
And the other one I wanted to make you all aware of is the FATCA, the Foreign Account Transaction Compliance Act. And that is the form that you fill out to be compliant. There is the form 8938. The thresholds vary depending on your physical presence, whether you're a US resident or an overseas resident. Notice how you're still a resident. That's the funny thing with the US, is that doesn't change. And that's going to depend, your need to file is going to depend on your filing status as well. So MFJ is married filing joint, and that threshold is just going to differ a little bit there. The next tax compliance point I wanted to go into was actually an investment restriction. It's not so much a tax compliance, although it becomes a tax compliance issue, given what Brad was saying earlier about the onerous requirements involved with even completing these forms. There was a finer point I wanted to add to what Brad mentioned here, because I've sat through so many countless hours of tedious PFIC presentations that I've heard a lot of war stories from folks. But let's just focus on the test here, and this is why it captures so many managed investment vehicles. There's two tests, and that is there's 75% of gross income for the taxable year is passive income. Do you own some sort of investment vehicle? And notice I'm using a much broader term than simply managed investment, like an ETF, a REIT, or a managed fund, because it can include limited partnerships, it can include LLCs, it can include basically anything that satisfies these two tests here. So was more than or 75% of the gross income for the year passive in nature, or more than 50% of the assets held on the books are they held to produce passive income. Where this can catch business owners outside of their personal financial situations, which is going to be very, very common, would be with a funded startup. So let's say you had a startup that received its initial funding in the last quarter of the year. The business wasn't in a position to draw down on those funds quite yet. And so they're just sitting in the bank account, hopefully earning 5%, as you can be these days with interest rates having gone up as they have. Well, the bad news there is there's known to be a rule with PFICs, and that's once a PFIC, always a PFIC. So now that company has attracted PFIC status. If it was registered overseas, and this would not be so much the case of the business owner moving to the US, but more the other way around. If this was an American tax resident who had a startup located overseas and it was funded in that manner, then that startup could be a PFIC itself. Fresh basis step up. This is an area where Brad spoke about a little bit earlier, and it's helpful to draw a distinction here. So Australia effectively grants a step up in basis equal to the fair market value of an asset on the date you resume Australian tax residency. So Australia's approach is you've gone away, assuming this is property acquired while abroad and it wasn't Australian taxable property, such as what real estate would be, or holdings in your company that you had before you left Australia. Let's say it's not that. These are RSUs, stock options, or stock that you acquired while you're in the US. It's done really well. You move back to Australia, assuming you're not a permanent resident or citizen. Australia says, "Welcome back, mate. Let's look at the stock exchange to see the fair market value of that asset and the date you resume Australian tax residency. Congratulations. We're going to step up your basis to that fair market value." The US does not do that. In fact, the US, I think, is quite unfair in how it treats the basis of assets. So I've got a number of clients in this situation where in the 1990s, they were executives in Australia earning good money. Then in the early 2000s, an opportunity came up to get transferred over to the US. They owned houses, they had superannuation accounts, they had stock accounts, all sorts of different assets, long before they ever even dreamt of moving to the US. Well, the IRS doesn't care about that. The IRS says, you've come to the United States. Hey, by the way, when did you happen to acquire that house you're now selling? Which is also, by the way, no longer your primary residence because you haven't lived in it for however many years. There's also your stock portfolio. Never mind if it's also a PFIC. We want to know the original basis of that. So what I'm trying to draw your attention to here, and this, in fact, I think is the overarching message of today's presentation. If you are an Australian business owner moving to the United States, you need to be very, very careful to take some tax steps and tax moves in order to try and avoid the worst outcomes that can happen. And we just spoke about, I think the worst would be the owning the stocks through the Australian Family Trust, having an exit event while still a US tax resident. I think good planning in such a situation where you're looking to expand your business to the US would probably be some sort of re-domestication, which is a funny word, but some sort of re-domestication to the US in order to get some sort of step up in basis. Brad, do you have any comments to make on that one?
I think that's a fantastic summary. I'll just add on that, and perhaps I didn't really cover it in detail before, would be that Australia does have an exit tax when you leave Australia, but it can be deferred. So what that means is you leave Australia for your non-real property assets. So Australian property is not part of that exit tax. So look at shares, investments, or if you're a private company you own both in Australia or anywhere in the world. So you can either pay that exit charge when you leave Australia, or you can defer it. Now, if you defer it and you move to the US and you sell those assets from the US under the tax treaty with America, you would just pay US capital gains tax on that sale, not Australian tax. And to confirm, this is individual assets you own, not in a trust. So individual assets you own personally. That outcome is actually a pretty good one. US rate of CGT is actually pretty good, often a bit lower than Australia. It's not a bad outcome. But the thing to think about is it can be sometimes be beneficial to pay this exit tax when you leave Australia, if when you leave there's nil or a small value gain on those assets, because that means that if you come back to Australia and you've elected to pay the exit tax, you get a fresh basis step up when you come back. So you can quarantine the growth that's accrued since you've left Australia. Whereas if you do not pay that exit tax when you leave Australia and you come back to Australia, you don't get that basis step up. So, just say you had your own Australian business, you left Australia, spent 10 years abroad, did not pay the exit tax, came back to Australia and sold it, you're going to pay full Aussie tax on the sale. Whereas if you paid that exit tax when you left Australia and your company was worth nothing, you effectively get a step up in basis of the company when you come back to Australia and potentially get a very good tax outcome.
And that's perfectly stated. That's exactly the situation that I was hoping to draw listeners' attention to. So here we are with this check the box election. That's what you're doing on the US side to get this step up in basis. Not a free step up in basis unless you're coming from the UAE or the Bahamas or somewhere. Coming from Australia, there is still that exit tax that Brad mentioned there. It's actually a philosophical point that I'd like to make as well, and I'm sure Brad agrees with this. And if not, then you're welcome to have your commentary, because I think that's the value of having two different professionals on the line. I think Australia and the US actually tax many of the same events, just use different names for the same thing. So Australia doesn't have a state tax, but they don't give you a step up in basis. Whereas the US has an estate tax, but they give you a step up in basis. So financial journalists will look to other countries like Australia and say, we want to be more like Australia and have no estate tax. It's like, hold on a minute. Actually, Australia really does have an estate tax, because there's taxes on superannuation to non-financial dependents. There's no step in basis, with the exception of a primary residence, and even that has a time frame. So there's that example, and the exit tax that you just pointed out, Brad, where you leave Australia and we, people that don't know, they say, Australia's so good, no exit tax. It's like, well, not so fast. They don't call it an exit tax, but it really is.
Yeah, so true. Yeah, it's a really good point you make. And I think Australia can sort of catch you out in different ways. They're a bit sneaky, perhaps. As you said, Australia doesn't have obviously an estate tax, but they've got other ways of capturing that. And one point too is that in the US, you can obviously file as a married couple, file jointly, which means that you're taxed as a married couple based on your combined income, whereas in Australia you must file individually. That normally can be a bad outcome, because all the income is taxed to that person based on what they earn. You can't really split it between you. So interesting. I think, my view is that I think Australia should move towards that married filing jointly approach. We're not going to, I don't think, but yeah.
Yeah, that's what I say. Australia has got the knockout combo when you come back, especially for people in the IT sector. I find so individuals working in IT in the US, they get paid more in nominal dollars. So they're getting paid more. First, well, it's US dollars, and the pay rate is typically higher anyway. So they come back to Australia, they get paid less. They're getting paid in Australian dollars. They just lost their tax filing status, and the rates are higher and kick in earlier. So it's you're on the ropes, if you're in that situation. having returned to Australia. Here's a diagram I put together to describe this tax treatment to do with superannuation accounts. So the general heading here is with retirement plans. As you're beginning to think about your move out of Australia to the US, what to do with your superannuation account? Well, I think you should take care of it before you go. That's the first thing, because as Brad said before, the IRS doesn't, not only do they not like superannuation accounts, they don't really know what they are. They haven't made any clear determinations for sure. Are they deferred compensation arrangements? Are they pension accounts? What are they in fact? So whatever you're going to do, assuming you're not already a dual citizen or a permanent resident, do it before you come to the US. And here would be my general back of the envelope recommendation if I was just talking to that generic individual who didn't have a self-managed super fund. I would say you want to put that into a regular a regular retail superannuation account, having confirmed that you didn't contribute through personal contributions, not to be confused with employer contributions, that you didn't make 50% or more of the contributions to that account, that you haven't been, while a US tax resident, that you haven't been rolling it over or changing the investment options available within that account. If it's just a case that it's a boring, simple superannuation account, mostly, if not entirely, funded by your employer, just in a simple target date fund or some generic risk option fund, then you should be good to go with regards to not being taxed on that account while you're in the US. So the best outcome I could imagine would be the business owner moving to the US for a short period of, whatever that is, 5-10 years, move to the US. They have this super in Australia. They've just put it with Aussie Super or Vanguard or someone like that, low cost, high performing superannuation provider. And they are not taxed on that on a mark-to-market annual basis. And that's why the grantor trust is so bad, is because the kinds of individuals we're addressing here today that have moved to the US that are making really good money, if they've got real growth happening in their super account, then they're being taxed at their highest marginal rate for every year that they hold that account. And then what's worse is if they move back to Australia, there's never some sort of tax credit to make up for that. It was just deemed taxable income at the time that they're in the US, and it didn't need to happen. So it's like a real tax penalty. Retirement plans to be aware of in the US, really three I would draw your attention to: 401ks, traditional IRAs, and defined benefit plans. Not many people have heard about defined benefit plans. These are the good old-fashioned pension plans that folks used to have in the 60s and 70s. They fell out of fashion in the 80s and 90s when employers realized that they're on the hook for the funding for these accounts. But if you own a professional services firm, say a financial planning firm, accounting firm, tax firm, a law firm, perhaps architecture, engineering, something like that, this is a plan that could be fantastic. It's age-based, so the amount you may contribute depends on your age, but you can be putting away up to $265,000 a year on a tax-free basis. And I didn't misspeak. For American tax residents, that would be tax deferred, because then they pay ordinary income tax when they distribute that account. But if you are not a permanent resident or a US citizen, when you come back to Australia, there are some ways of rolling that over into a traditional IRA and then distributing that account, which can result in very attractive tax outcomes. But the reason this particular point is worth making about contributing to the retirement plans is because often folks will move to the US and they'll say, oh, I don't want to get involved in a 401k. That sounds complicated. They're going to take my money. I don't know how I'm going to get it back. It's not the case. Often it's one of the best things that you could be doing, especially given the way that the rules work for moving that back to Australia. Lastly, just in the interest of time, because we're coming up against the limit here, I wanted to talk about the HEART Act, the Heroes Earnings and Repatriation Tax Act of 2008. This is the exit tax. So I just wanted to bring you over to a diagram that I have here. Just bringing that up on the screen right now. The US exit tax and determining covered expat status. So how does this work? So let's see here. The first thing you need to ask yourself is is the expatriating individual a long-term resident or citizen of the United States? Now, note the tiny little quote mark about long-term resident. That has a very special definition. That refers to whether you were a permanent resident of the US for 8 of the past 15 years. Now, what's important to note there is, did you hold that permanent residency status at all? It doesn't matter if you weren't in the US necessarily. There is an exception for whether you chose to elect for, and this is where Brad comes into it, and why you do well to engage with someone like Brad if this was your situation, because there is a little known exception, and that is if you opt for tax, if you're filing your W-8 BEN and the other forms appropriate for electing treaty tax treatment, then in fact that can press pause on the clock of the 8 of the past 15 years. However, if you've been in the US for 8 of the past 15 years, and that's 1 minute into the 8th year, so it's really should be the better way of saying it would be more than 7 years, then you're considered a long-term resident. Okay, then what does that mean? Did the US citizen relinquish citizenship, or did the individual cease to be a long-term tax resident? Let's say they do. In that case, they're going to say, do one of these 3 tests apply? And here are the 3 tests. Did you have an average net income tax liability? That's not to be confused with net income. People read that and go, oh, I made $200,000 last year. No. This is tax liability. So you're going to be making pretty good money to fall foul of this one. In my estimates, depending on whether you're a single or married filing joint taxpayer, it's over $600,000 to $700,000 on an annualized basis, or if you had a huge exit, that could skew your 5-year average as well and put it above that limit. So that's the first test. The good news with the first test is not only is it relatively high, but it's indexed on an annual basis. The bad news comes with the second test. The second test is a global net worth of $2 million. So that means the value of your cars, the coins that have fallen between your couch cushions, your superannuation account, absolutely everything. Global net worth of more than 2 million. And many Australians live in California or New York who own their own homes. When you begin to include that in your balance sheet, you can see it's very easy to exceed that level. There is a little bit of good news. It's only a little bit of good news, and that is there is a capital gains exemption amount. It was about $780,000 that you can have a capital gain of that amount before you're paying tax on it. But the bad news is that you've received this nasty brand on your arm that says covered expat. That covered expat status stays with you forever, and worse. And Brad, this may be the subject of a webinar that you and I do when we've got a lot more gray hair or less hair on the head. But there's an impact for your kids if they're US citizens. This is a sleeper provision that's written into the HART Act. And that is, if you've got US tax resident beneficiaries of a covered expat, they're immediately hit with a very nasty rate of tax themselves. So for folks expatriating who don't have kids, that doesn't matter. But if you do have US citizen children who may be the heirs of your estate at some point in the future, then that can be something to avoid. And of course, the third one, this is where we always encourage our clients to be compliant with, because you can't even expatriate and sign this form if you haven't been compliant with your state and federal tax obligations in the first place. So that's the diagram there for the HART Act. I want to take the presentation back to the slide deck we were just looking at. And we're going to wrap things up in just a second here. Unusually for me, as I mentioned, thank you, Brad, and everyone else for your patience last month. I got sick. I had to defer. We had to reschedule today's presentation. So next week, I've actually got the final installment of what's turned out to be a very popular series. It's funny when I talk about dry technical things like this here today, Brad, you've made it more lively, but dry tech people aren't so interested. But when I talk about my actual life and how we've engineered living this cross-border life, people are like, oh yeah, I'll tune in for that. So that's on next week. I hope you can join us for that. Lessons learned. If you're interested in making contact with me, then please come to my website, WA. What's that? Wealth advisors, I guess you could think of. It's actually Wealth Australia. There's the S goes silent there. Go to the Get Started page. Brad, how would folks make contact with you?
Yeah, thanks, Ash. Please reach out. My website is murphytax.com.au, or please drop me an email at bradley@murphytax.com.au. But yeah, I think if you do a simple Google search of Murphy Tax lawyers and advisors, it should pop up. There we go. Yep. Yeah, unfortunately, my face is front and center, so can't miss it. But yeah, thanks for having me on as well. Ashley, it was great to join you. And yeah, if anyone's got any questions, please just feel free to drop me an email and give me a call.